You can't control what the market does, but you can get clarity on how retirement investing works. And that clarity might result in better decisions where it really matters. There are a lot of videos out there, including some from me, that do a deep dive on how to invest for retirement. But those specific tactics aren't useful for everybody. Sometimes it's helpful to see the landscape from a higher level, and that's what this video is about. Every year, JP Morgan puts out a massive set of charts in their guide to retirement. It is packed with data, but I've selected a few of my favorite insights that we can walk through together, and we'll supplement with some other sources of information as well. We'll stick to those investment-related topics for now, and I might come back to other parts of the guide in a future video. Just let me know what you think. We'll start with the question of who are you as an investor? And this might seem remedial, but it really is critical because you might be playing a different game than everybody else who's talking at you on the internet. And what they say might be irrelevant or counterproductive. So be sure to settle on who you are, what game you're playing, and what you want out of your investing. We can see a couple different profiles here. You hit your retirement date and time passes and the amount of money you have. So starting at the top here, we've got increasing wealth. And I don't see a lot of this, but I do occasionally have clients who maybe have a good Social Security income and or pensions. They've got very low expenses, and maybe they're spending just a tiny fraction of their assets every year. In those cases, the portfolio is highly likely to grow. So there are people who are going to increase their wealth and even want to do that. Maybe you want to pass on as much as you can or give away as much as you can, and that's great. But it's not necessarily the case that you need to pursue a lot of growth and have high stock exposure, for example. There are others who say, you know what, I've won the game. Why don't I just stop playing? I don't need to take risks in order to meet my goals. I'm going to be able to spend all the money I want and give away a lot of money. Why don't I keep it simple so that I can sleep at night and not take a lot of risk? That is perfectly reasonable as well. Next, we've got preserving principal or spending only the investment return. And this is an interesting one because this is what people often say that they want. People might say, I want to figure out how to just spend the earnings, live off the interest, for example. And what I would say is it's not realistic for most people. And it's also, I'm not sure, the best way to do your retirement income planning because in that case, you're really spending whatever the market happens to give you, whatever maybe interest you earn or whatever dividends you get. But is that the amount you want to spend? Maybe you want to spend more. So I think it's best to focus on an amount that's going to make you happy and meet your goals and not just live off of the interest. The other issue with that is you need a lot of money to make it happen. So let's say you want $50,000 per year and you can get 4%. Well, then you're going to need 1.2 million to do that. And that might be very achievable for a lot of you. Most people in the US are retiring with less than that. And you can't necessarily guarantee what you're going to get from the markets. Let's say you can get 6%, might be only 833K, only 833K. It's hard to guarantee a couple of things here. One is the return is not set in stone. So if you lose money in a given year, for example, your principal goes down. And what does that mean for your investments? Maybe nothing if you're locking in yield and that type of thing. But locking in a yield doesn't sound super possible to me either, because let's say you can get 6% today. What's going to happen if that changes? Again, if it goes down to 4% or something like that, it turns out that you may be short on money. It is conceivably possible, I suppose, to get long-term fixed income investments that are going to pay for, let's say, 30 plus years. That may be doable. It doesn't give you a lot of flexibility, but it may be something you can do. Again, I'm just not sure it's the best way to approach this. That brings us to what I see most people doing, and that is spending down their principal. So that's spending a portion of the amount that you have saved plus the earnings each year, and doing that in a way that is not going to cause you to run out of money before you're expected to run out of life. A lot of uncertainty there, a lot of what ifs, difficult to do, but that's where you get the so-called rules of thumb that I don't suggest you follow, it is a good idea to do some detailed planning and figure out how this might unfold for you. And really important to keep in mind that you may want to have a dynamic withdrawal strategy or be able to make adjustments. So the dynamic withdrawal strategies are things like guardrails. Maybe you take a little pay cut if the market crashes, especially early in retirement. Maybe it's not as big as you think it has to be. Maybe you can skip some inflation adjustments. Who knows? It just depends on what's going on. But if you're able to be flexible, then that is often a good thing. All right, so figure out who you want to be as a retirement investor, and that will drive the types of investments you use. Then we can do a temperature check here. This was a survey where they ask, how would you describe your investment risk tolerance at these different points in time? And I should point out that this was like a hypothetical question. So it's not like everybody who was age 70 answered, and that's where the data goes in here, and everybody who was age 40 answered, and the data goes in here. It was more of a hypothetical. What do you think you will want to be like? What would you be like at this age? What you see is not very surprising. Typically, people are more tolerant of risk in their younger years, and then they're expecting to and wanting to have less risk later in life. And that's consistent with what I see with clients. That's in spite of the fact that there is some research, we'll look at that in a second, that might say you could use an increasing equity glide path. In other words, add to your stocks as you get older instead of continuing to taper down like this. I just don't run across a lot of people who have the appetite for that. Again, sometimes you say, look, I've won the game. Why am I going to keep playing? Everything's going to work out for me, so I'm good. There is some information from Kitz's here on the portfolio size effect. Kind of gets at the increasing equity glide path. Not necessarily, but he's got other research on that. And let's take a look at that a little bit closer. So what he's essentially talking about is you've got this retirement red zone here. So if your retirement date is right at age 65, then the couple years before and the couple years after are critical to your retirement. And he discusses here using a bond tent because this is shaped like an old school tent. And what you're doing is increasing the bond allocation over time and then kind of ramping it up really as you hit that retirement date and then gradually coming back down. I'm not sure that this is the exact right amount of bond exposure to have. It's more the concept that I want to highlight here, and you can pick your own numbers. But the idea is that your wealth, or the blue line here, the money you have, is probably at its highest right around your retirement date, and that puts you at the most risk. That's that sequence of returns risk that you've certainly heard about. And so a way to manage that is to use something like a bond tent here where you greatly reduce the risk. I mean, again, I don't know if this is the right amount. There could be tax consequences of trying to make this happen. But again, we're talking about the concept. Maybe you want to set up your bond tent a little bit earlier. You could get away with doing it later. I don't really know. But in this case, he's got you coming back down to a 40% bond allocation. So you're 60-40. Again, there is some research that would say maybe you ramp up that stock exposure as you age because sometimes that can work out for you. Another way to accomplish that might be with cash reserve. Then there's also bucketing, or time segmentation is what we can call it, is looking at different buckets of money with different objectives. So the money you're going to spend in the very near term, you typically want to have in safer type investments, cash equivalents. This might be actual savings accounts, CDs, T-bills, that sort of thing. Maybe money market funds, maybe high quality short-term bonds. But then you may have another one that's a little bit higher risk that's going to hopefully pay a little more, and then it'll fund this first bucket. And then you would have a longer term portfolio that you don't expect to touch for maybe 10 plus years. And since you have 10 plus years, that might give you the confidence to invest that portion of the portfolio with more risk. And you say, look, I believe that over 10 years, no guarantees, you could lose it all, but you might say, I believe over 10 years that I will be gaining in that. So I'm okay with investing mostly in stocks or heavily in stocks. My own view, and I've got a video on this if you want to check it out, is that a rigid approach like this is maybe not the best way to go. I think it's pretty difficult to maintain. So on the day you retire, if you set this up, it is absolutely gorgeous and it looks great and it makes sense. And you say, okay, I've got it all figured out. But the problem is that as time passes and things gain and lose value, your pie pieces become bigger and smaller, and you have to adjust all that stuff. It can get a lot more complicated than you might want. And, that's especially difficult as you get older, if you're experiencing cognitive decline, and if you just want to spend your time doing other things. So, what I do with clients, or what I recommend when I talk to people, if they're going to do it themselves, is something closer to maybe a two bucket approach if you want to get creative and keep using that word. And that is going to be number one, a cash reserve with a relatively short period of time covered with cash type investments, and then a total return portfolio at whatever level of risk is appropriate for you. And what ends up happening is it's maybe not too different from what you see here, but it's just easier to maintain because in a typical portfolio, let's just say it's 60-40 as an example, not recommending that. But in a 60-40 portfolio, 60% of the money is in stocks. And so that might be close to what you would end up having anyway if you were doing a bucketing approach like this. And you've got some assets in various types of bonds, not just one type of bonds, but various types of bonds at varying risk levels and yields. And so that might end up functioning kind of similar to this, where it feeds the cash bucket or provides money to draw on. So that can sometimes end up working the same way, but check out that video if you want to look at that anymore. Next, we've got down here at the bottom, this is often one of my favorite charts. And what it shows you is rolling returns over different rolling periods. So what does rolling return mean? Well, here we've got 1950 to 2024. So every 5-year period in there might be 1950 to 1955, or technically 1954, but then 1951 to 56, and then 52 to 57, 53 to 58. You get it. Every single slice of history that is available for 10 years long or 20 or whatever. And what we generally see here is that the bars tend to kind of narrow, and they also kind of tend to come up above that zero line. So there is no guarantee on any of this, of course. The past may not repeat itself. Past performance is no guarantee of future results. Your mileage may vary, and you can lose money investing. But what we generally see is narrowing and moving upwards. So over a 1-year period, stocks are anywhere. You might as well walk into a casino. And by the way, we're looking at this bar is 100% stock, 100% bonds, 50-50 portfolio, and cash. And again, over longer periods, even 5 years, kind of surprising, only a handful of periods are below that zero line, 10-year periods and 20-year periods again. So really what this shows you, and I think all of you know this, is that over the long term, if you have time, this volatility and the 1-year stuff tends to come out in the wash. So you need to keep that longer term perspective as an investor. And hopefully this gives you a little bit of confidence during times of turmoil and helps to remind you what has happened in the past. All right, now we've got a Callan chart, and this is really busy. If you can't read it, don't worry. Don't squint too hard. You're not supposed to be able to make sense of it. What it's showing is across the top is a bunch of years on up to 2024, back to 2010. And all of these different colors are different types of investments. And as you can see, it's kind of total chaos. So I guess let's look at 2018 here. It's got them in order of what did best in that year. So cash was best, and then fixed income was next, and then REITs, high yield, large cap, small cap, commodity. DM is developed markets, so overseas equity. EM is emerging markets. That's the order of how things performed in a given year. It is hard to make sense of this, but what you may notice is this light gray asset allocation tends to be sort of near the middle, and they've highlighted it with a line because that is what we're hoping to focus the attention on. And asset allocation is essentially a little bit of everything. So you invest in a little bit of all this stuff. And in this case, it's similar to a 60-40 portfolio. And what you see is that it's never the best, never on the top, and it's never on the bottom. It's never the worst, but it's somewhere in the middle there, and it's probably a decent way to invest. So instead of trying to shift all your money to something in a given year or trying to make bets on anything because it might end up at the top or the bottom, you can often get just a decent or acceptable return if you diversify. And by that, I mean, when I look at retirement plans for people, the question is, are they going to make it, right? Are they going to be able to spend what they want? Are they going to run out of money? Are they going to be okay is the question. And with an asset allocation or a diversified portfolio, that's typically the case. And I'm not saying 60-40 is the right amount, but you pick your risk level and you have a mix of everything. So that way you're never having to place bets that might go badly for you. We've also got on the far left the average annual over a number of years, so from 2010 to 2024. And remember, this is an interesting period where, especially lately with the large cap, especially growth technology stuff, those have done quite well. So I'm not sure every period will look exactly like this. But we've got our asset allocation portfolio that did 7.2% per year. Again, past performance, no guarantee of future results. You can lose money. But the volatility here was about 2/3 of what it was on the large cap, which happened to be the best performer. So again, not the best over the long term, not the worst, and it usually works with client plans. And what this is really hoping to discourage or encourage is encourage asset allocation, spreading it out at whatever risk level is right for you. But discourage, you say, well, 2018 cash was the best. I might as well have had my money in the bank or under the mattress because everything else lost a bunch of money. So I'm going to go to cash. Well, it turns out in 2019 that it ended up being the worst performing of all of those. So it's just so hard to predict. You never know what's going to happen. If you do a decent job of spreading it out and then maybe have that cash reserve for downturns, for some spending, then it can often work well for people. And I would also point out that on the previous slides, this one has a bunch of different asset classes, and not even all of them fixed income. They have high yield and fixed income, but they don't have corporates and short-term government versus long-term government. But on all the previous slides, we've just been talking stocks and bonds. We haven't even gotten into this level of detail. Yeah, I talked to so many people who are like, should I use VTI or VOO? They're really in the weeds on this stuff, and I don't think that's helpful for them. Those typically aren't the most important decisions to make. I mean, yes, you want to pick good investments, but sometimes people get overwhelmed and too much in the weeds. So hopefully this suggests that simplification can be okay. Now, I did include this slide, which is more of a Social Security slide. And by the way, the last one was from the Guide to the Markets, but it is investment related. And what I don't like to oversimplify too much is Social Security claiming. But the fact is that people sometimes want to get a framework of how to look at things. And I think this one is halfway decent. So it's telling you, should you claim at 62 FRA or 70? Of course, you can claim anywhere in between, any month in between there. And it seems to say that that has something to do with longevity. And these numbers are, of course, not exact. It's a chart that you could have drawn with crayons, but we're talking about the basic concepts here. So it seems to say if you expect longevity, maybe claim at 70, expect a shorter life, maybe you have a diagnosis or something, or maybe you just need the cash flow to retire, then an earlier claiming might make sense. But the reason I bring it up here is we're also talking about investing. So sometimes you hear people say, well, should I just claim early and invest that money or leave my money invested? Versus if you claim at 70, you're often going to be spending down some assets. And by the way, that can make a lot of good sense if you're doing some tax strategy, like trying to manage your future RMDs. But when people ask that question, they often wonder, should I just invest or stay invested? This suggests that your investment return does have something to do with it. So let's say you're around 82 or 3 or something where you could be in any of these age ranges. And so if you're going to have lowish returns, this seems to say maybe claim at 70. If you're going to have higher, super high returns, maybe you want to claim earlier and leave that money invested or invest your benefits. But what I would say is the people that I typically talk to, they're hitting retirement, that sort of thing. They're typically not aiming for these 9 and 10% returns. Maybe you are, maybe you can get that. That's fine. It's certainly not something that I would guarantee anybody or even feel comfortable saying that I think they'll get, because you never know what's going to happen. So if you think you would get that, sure, maybe it makes sense. But again, what I see with most people is they are on the more conservative end, which tends to point towards spending down the assets a little bit. And again, there may be tax benefits of doing that and then claiming later. And yeah, there's also maybe survivor benefits to consider. There are a lot of things that you want to think about. We do have some research from David Blanchett as well. He used to be with Morningstar, if you remember that name. Now he's with PGIM. What he tried to figure out is what would you need to earn if you're going to claim early versus delay. And the gist of it was that for most longevity planning ages, a lot of people are planning for 90 plus, and we can quibble about that, but pretty likely that you or somebody in your household would make it that long. Not everybody will. But for longevity, the break even might be 8% plus for an individual, and then maybe closer to 10 for a married couple. So you can read through this and see what you think about it. He's got different stuff in there for if you expect to have a longer than average life or shorter than average life, or if you've got a spouse, will they have a longer or shorter than average life? But the thing I guess I'd say about all that is if you think you'll die early, don't be so sure. Only time will tell, and doctors keep doing a lot to keep people alive longer, so you might be surprised. Right, and then remember that this is just one aspect of your retirement investing, and a lot of people would argue it's not even the most complicated piece of it. You also need to focus on tax management and Social Security decisions, obviously, withdrawals, making the money last, healthcare, and all that. So the video popping up now should help you with some of those bigger picture items. And I hope you found this helpful. If you did, please leave a quick thumbs up. I look forward to talking to you soon.